Credit card companies make money when you make mistakes. They want you to carry a balance, miss payments, and pay annual fees for perks you'll never use. But if you know how the system works, you can flip the script and make their system work for you. Here are 5 credit card hacks that banks actively hope you never figure out, and each one puts real money back in your pocket. Most people think the grace period is just the time before interest kicks in. It's more powerful than that. If you pay your statement balance in full every month, you get what's essentially a 50-day interest-free loan on every purchase. Here's how to maximize it. Make large purchases right after your statement closes, not right before. If your statement closes on the 15th and you buy a $1,000 laptop on the 16th, that purchase won't appear on your statement until the following month, and you won't need to pay for it until the month after that. That's up to 55 days of float. Meanwhile, that $1,000 sits in your high-yield savings account earning 4% interest. Over a year of strategic timing, you can earn $50 in free interest on money you were going to spend anyway. The key rule: you must pay the full statement balance every month. If you carry a balance even once, you lose the grace period and interest accrues immediately on all new purchases. One missed payment undoes months of optimization. When you have credit card debt, the interest is killing you. 20 to 30% APR is normal, but banks offer balance transfer cards with 0% intro APR for 12-21 months. Transfer your balance, pay no interest for over a year, and use that time to actually pay down the principal. But here's the advanced version. Instead of just paying it off, take the money you would have paid in interest and put it in a high-yield savings account at 4 to 5%. You earn interest on the bank's money while paying zero. Example: $5,000 balance at 22% APR minimum interest per year, $1,100. Transfer to a 0% card. Put that $1,100 in a 4.5% HISA over 15 months. You earn roughly $60 in savings interest plus save the $1,100 in credit card interest. That's $1,160 swing from one balance transfer. Watch out for transfer fees, usually 3 to 5%. On $5,000, a 3% fee is $150. Still worth it. You save $950 net. And some cards offer $0 transfer fees during promotional periods. Look for those. Banks offer sign-up bonuses worth $200, $750 in cash or travel points when you open a new credit card and spend a certain amount in the first 3 months. The trick is to only open cards for purchases you were already going to make. Here's the system. Plan your major expenses: car repairs, furniture, insurance premiums, holiday shopping, and open a card with a sign-up bonus right before those expenses hit. You hit the spending requirement naturally, get the bonus, and don't spend $1 more than you would have anyway. The Chase Sapphire Preferred offers 60,000 points, worth $750 in travel, when you spend $4,000 in 3 months. If you have $4,000 in planned expenses anyway, that's effectively $750 free. Do this twice a year with different card issuers: Chase, Amex, Capital One, Citi, and you can generate $1,000 to $1,500 annually in bonuses. Rules: don't apply for more than 5 cards per 24 months. Chase 5/24 rule: always pay the balance in full. Never keep a card with an annual fee if you're not using the benefits. Downgrade to a no-fee version before the annual fee hits. Your credit score is 30% determined by credit utilization, the ratio of your balance to your limit. Below 10% is excellent. Above 30% is concerning. But here's what banks don't tell you. The utilization reported to credit bureaus is your balance on the statement closing date, not your balance at the end of the month. This means you can manipulate your reported utilization by paying your balance before the statement closes. If your limit is $5,000 and you've spent $3,000 this month, your utilization would be 60%. Terrible. But if you pay $2,800 before the statement closes, your reported balance is only $200. 4% utilization. Excellent. Do this 2-3 months before applying for a mortgage, car loan, or new credit card. Lower utilization means a higher credit score, which means lower interest rates on everything you borrow. On a $300,000 mortgage, a 0.5% rate difference from a 20-point credit score increase saves you $26,000 over the loan term. Set a calendar reminder for 3 days before each statement closing date. Pay down to under 10% utilization. Wait for the statement to close. then pay the remaining balance. This costs you nothing and can raise your score by 10-30 points in 2 months. This sounds boring, but it's the most important hack on this list. A single late payment drops your credit score by 60-100 points and stays on your report for 7 years. One missed payment on a $50 balance can cost you thousands in higher interest over the next decade. Set up automatic minimum payments on every credit card. This ensures you never miss a payment even if you forget, travel, or have an emergency. Then manually pay the full balance when you can. This is a safety net, not a strategy. The auto pay covers the minimum so your credit never takes a hit. You still pay the full balance manually to avoid interest. But if life happens, and it will, the minimum payment goes through automatically. Bonus hack. Set the auto pay to pull from a separate checking account that only has enough for minimum payments. This way, even if your main account gets compromised or overdraws, your credit card payments still go through. Credit cards are tools in the hands of someone who doesn't understand them. They're weapons that destroy finances. In the hands of someone who does, they're interest-free loans, free travel, and free cash. The difference is knowledge. Pick one hack from this list and use it this month. Start with the grace period trick. It requires nothing but timing. Then build from there. Subscribe for weekly finance breakdowns. No fluff, just things that work.